Welcome, everybody. Thank you for joining. Due to popular demand, a lot of people have asked me for a series basically of life lessons and investment advice 101 and how people can get started. A lot of people that watch this channel are new to investing, and some people call them noobs or newbies. And I decided to put together this series to help you all, and I want to share all the lessons that I've learned and everything I've learned from books and education, everything else with you all, so you can all be successful. So without further ado, this is called Investing 101 Part 1. And this channel, of course, is about math, money, and freedom. Freedom, financial freedom, and the ways to get there. And the first and most important thing to know is investing difficult? And the answer is yes, it is. So much so that many people in the profession are actually clueless. Now, I don't want to disparage anybody out there, but when I see people interviewed on TV and on YouTube who are supposed experts, and I hear the stuff coming out of their mouths, I just want to pull my hair out. So it's like infuriating when I hear people lead people astray, pushing things that are just silly, like gold and things like that. I just go, oh, why are they doing this? Anyway, but be calm and let it go. So let's talk about what I believe are the investing 101 skills that everybody needs to be a superhero. And to be a superhero is required, because if you are mediocre, you're going to lose. Because if you follow the herd, you're going to lose. And I'll talk more about the herd mentality as well. So let's jump into what I believe are the 5 must-haves. You need the right mindset. And I'm going to go deep into that today, because if you don't have the right frame of mind, you're going to fail. Then you need financial literacy. Very, very important to understand. I'm going to go through lexicons and everything you need to know to be an expert, because if you don't speak the lingo, it's hard to get by. And then you need analytical skills, not only for technical analysis, but also to analyze things like option prices and stock prices and financial records, etc. And fourth, the ability to generate perpetual income. This is not about having one big hit and making $1 million, because nowadays $1 million doesn't last very long. But you need the ability to generate perpetual income. That's the end game, okay? Not get rich quick, but have something dripping money in month to month to cover all your and your family expenses as you go through life. And the fifth part is financial discipline. Discipline is the most important thing. Patience and discipline, and that continuous ability to learn is very, very important. If you want to play this game, you got to keep your skills sharp, because the game changes very fast. So, the right mindset, part 1. I'll go through this very quick. There's a lot of really good life lessons here and a lot of cool anecdotal stories I'll walk you all through as well. So, first of all, we got to talk about fear. So, it's very important to use fear as an engine and not as a brake. Now, what I mean by this is sometimes when people are afraid, they're a deer in the headlights. And I have a whole bunch of examples that I show you as well. So again, use your fear as something that motivates you to get better, not to something that says, okay, I can't do this anymore, I'm just going to quit the game altogether. Second of all, greed. This is an old saying from the past. Pigs get fat and hogs get slaughtered. You don't want to be a hog. It's okay to be a little bit greedy, but not too greedy. So be aware of that as well. And again, examples are coming. Now, this is, an old Warren Buffett expression that I love. Be fearful when others are greedy, and be greedy when others are fearful. And the way I interpret this, when you see craziness in the market and everybody getting greedy, that's the time you kind of start hedging your bets. You back away from the table and you do your own thing. When you see the sky falling, place burning down, that's when I run in. So I'm a contrarian, always have been. I like to bottom fish. I remember, in March, I was ready. I didn't expect a pandemic, but I was ready. And I had been in cash for 1 or 2 years because I knew something big was coming. I thought it would be another financial crisis. And I know the market works in cycles and you can time them every 7 to 9 years. Anyway, that's that. So now, fear versus greed. Let's talk about this for a second. Fear is a response to a threat. Remember, we are animals and we come from nature. Greed is a response to an opportunity. We want more. We want better food, etc. Fear seeks to preserve the self. So when you add these together, obviously we are animals, we are primal, and therefore fear is designed to keep us alive. Therefore, it's stronger than greed. So in investing, in the investing world, fear is the biggest problem. And I'll tell you a little secret later as to how you overcome fear. It's real simple. So stay tuned for that. Now, the other thing that's very important is fear can take over logic. It'll confuse the brain. So I'll give you some examples of fear in investing and greed in investing that hopefully you can all relate to, because this is very important, especially for the new investors in the marketplace, especially in the crypto world. So fear, example number one, investors become worried about losses and they sell at the lowest levels. Imagine the stock market is capitulating. It's crashing at the bottom. That's when people panic and they get out. That's the time when people like me get in. So be aware of that. There are also people that are afraid to buy things like Bitcoin at $9,000 as they feel it's too high. They see Bitcoin going from 4,000 to 9,000 in a few months and they think, oh, I'm not buying that. That's too much. I'm going to wait for it to go back to $4,000. They're afraid. Sometimes fear, again, can make you make the wrong decisions. And then finally, the third example of fear is people are afraid of failure. So they hold on to losing stocks too long because they don't want to admit loss. That's also a fear. These are all bad things. And examples of greed in investing, they don't sell after 400% gains because they want more. Now, I remember I lived through the dot-com bust, and I knew a lot of people that had a huge amount of stock options in companies like Cisco, etc. They were multimillionaires on paper, but they waited. They didn't cash out, and they waited. The real smart people cashed out at the top, but a lot of people waited. They went from being multimillionaires to average people in the space of a year. And then another example of greed is people, and I've had these cases come into me through the channel. They have 1,000 coins that they bought for 1 or 2 cents each of 10 different altcoins because they want to be a millionaire. Again, this is greed, and this is dangerous. This is gambling. This is pure speculation and not good. So again, time to bring logic back into the game, and this is what this series is all about. Now, the other thing that's very important as well, it's moral, is don't allow your logical mind to be overtaken by emotions, be it greed or fear. The more you are relaxed about something, the less emotionally you are attached to trading and investing, the more successful you are. When literally you just don't give a damn, and you just, it's like walking through a casino and just dropping quarters in slot machines and walking by and just waiting for one to hit. That's when people win, and I've seen it firsthand. I've seen people rock up to poker tables and craps tables and just not care and just throw money at the table and have success. So this is what I'm talking about, is when people go into a situation and they're nervous and they're afraid, they don't do well. So keep that in mind as well. Now, this is a very interesting chart as well that talks about the cycle of emotions. So in the market, people can be optimistic when they jump in. Then they can get excited when they get their first gain in an investment. And then it's like a thrill. And then there's euphoria. And then things start turning around. They get a little bit anxious. Then there's some denial. Then the fear kicks in like we just spoke about. Then there's desperation. What do I do? And then panic. And then capitulation. They give up. They sell. And then despondency and depression. And then it comes back around to maybe a little hope, a little relief. They get back into the market and then more optimism. But the key is to control your emotions during these cycles. The more you disengage and the more tools you have to manage your risk, the safer you are and the better you are off mentally too. Because remember, it's also a mental game. The more broken your mind becomes because of all these different stresses and emotions, the less chance you have of making logical decisions. So the other thing that I want to stress is resist the herd psychology. I can't tell you how many people try to bring me down a path, and it's important not to get sucked in. But do your own research. Find your own path. Don't follow the herd. Be very, very, very careful. Come up with your own investment thesis. Stick to it. Now, if you find it's not working for you, be quick to pull the ripcord and get out, and then tweak your strategy and start again. And I'll talk about that towards the end of the video as well. So watch that. Don't follow the herd, as I said at the beginning. If you do, you're not going to do well. And then this is another thing as well, is the gambler's fallacy. It's also called the Monte Carlo fallacy. So think of rolling a dice, 1 through 6. People think, oh, I've had 3 6s in a row. There's no way a 4th 6 will come. But remember, it's random. You don't know what's going to happen. So a lot of people bet that the past is a guide to the future, but it's not. Also, a lot of people sometimes believe the world owes them something. It doesn't. It owes you nothing. And investments don't have to rise. They can stay flat or they can fall. They also owe you nothing. So it's very, very important. The little cartoon here is this person buying one of these scratch-off tickets, lottery tickets, which are a complete waste of money. I know the last 5 scratch-off tickets didn't win, which means this next one must be a winner. No, that's the gambler's fallacy. They're always waiting for that win, even though they keep losing. So be careful of that and don't get into that mindset. That can also happen if people get wedded to a loser and they follow it down. They think it's going to turn around. It's going to turn around. There's no way I can go this far down. It's going to turn around. Sometimes they do, but sometimes they don't. So also beware of overconfidence. I see a lot of this happening right now as well. There's people that buy, say, Cardano for 10 cents and it goes to $1.50 and they are delighted and they get very confident and they think they can take over the world and buy a whole bunch of other altcoins. Be careful. A lucky hit out of the gate can be a curse. It can drive too much overconfidence, and that is dangerous, okay? So also, watch who you listen to. There's people that hype stuff up out there on YouTube and other places. Be careful. Sometimes they're not telling the truth. So take everything with a grain of salt. And again, blaze your own path, okay? Don't follow the herd. And also, disaster can strike, and when it does, don't blame something else, but learn from the mistake. Okay, so very important. Now, the other thing that's very important is play the long game. So time is very, very important. Time gives you options, especially if you're dealing with things like options, derivatives. The more time you buy, the more options you have for a variety of outcomes. And also the old saying is time in the market is better than timing the market. And this goes well for things that are tied to like index funds, etc. Not necessarily stocks, because if you are a long time in a certain stock, like a GE or something like that, it's just going to go down over time, or other zombie type businesses. But the real point of this slide here is to talk about the power of compounding. Now, if you have a compound annual growth rate of 10% and you have an initial investment of $1,000, that'll be $2,600 at the end of 10 years. 20% will be $6,000. 50%, $57,000. 200% is what Bitcoin has done over the past 10 years. So an initial investment of $1,000 with a 200% compound annual growth rate is $59,000. And many of you saw last year what Tesla did. And Tesla, in the space of a year, less than a year, went from $40 to $900 very quickly. So again, that can happen. Of course, there's a 5-1 stock split in there in case anybody wants to debate me in the comments. So play the long game as well. Think about being in the market for a long time. Don't just jump in and jump out. But the longer you're in, the better your odds are. Of course, when you back the winners. And the other very important thing is consistency. So most successful investors in the marketplace are consistently good. They may not be hitting home runs all the time, but just making that 10, 20, 30% every year, that's all you need to do. But don't think about making 100% every quarter. That is not the right frame of mind. Yes, you might make it one quarter, but on average, it's extremely difficult to make it all the time. And remember risk management. Build slowly over time and manage your risk and be patient. I can't stress these little things enough. Patience. Now, a couple of other top tips, things that I've learned is know your style. Find out what you like doing. If you are passionate about something, it makes it much easier to do. So are you a scalper? Trading minute to minute, second to second, or are you a day trader? Or are you a swing trader or a position trader? I'm much more of a swing and position trader, and that's where I play and that's where I succeed. Find a system, keep it simple, and wash, rinse, repeat. Once you find your system, keep perfecting it. Find a space you like. It could be crypto. It could be disruption stocks. It could be value stocks. It could be dividend stocks. Find what you're comfortable with. Only invest in what you know. Make sure you understand the space deeply. If you know Coca-Cola, like Warren Buffett, because he drinks it, that's your thing. If you know space technology or rocket ships, maybe that's your thing. Who knows? Also, as you're learning this game, trade only with what you can afford to lose. And paper trade and start small. And don't overtrade. Be patient. Think sniper. I can't stress that enough. And I see some of the YouTubers up there and they're on Bloomberg in real time and they're, oh, I'm going to buy 200 of that and 500 of that. That is not the approach. You will fail. The most successful traders make very few trades, but they're good ones. And they wait. They wait like a hunter in the woods or a sniper. Very important. Don't overtrade. Don't feel compelled to invest all the time. Learn the game. Wait. Watch. Your opportunities will come around every single time. And if you're losing, stop and figure out why. Don't continue. Put the brakes on. Reassess the situation. And of course, never stop learning. That's what this channel is about, to share all of these little secrets that'll help. Now, this is another cool piece of information from Peter Lynch, is let the dogs loose and hold on to winners, as I call it. So, a couple of things here from him. He's one of the best investors of all time, and he's probably has the best investment book that I've ever read. So some investors have stocks that go up 20, 30%, and then they sell them. And then they keep the dogs. That's wrong. And let me step out and give you an example. Imagine you've got a portfolio of 10 stocks. One of them is Tesla last year. Tesla goes up 20%. You sell it, and you buy more of the dogs. You're toast. You gave away your once in a lifetime, 10xer that's going to happen. So don't sell your winners too early. And in the stock market, there are companies that just are very disruptive, change the game, and they're the ones you want to hold on to. So make sure you remember who they are and don't sell them too early. Okay. The second thing as well, don't buy cheap stocks. And this happens as well in the altcoin market, just because they're cheap. People think, oh, I can buy 1,000 coins at $1 each, and they're going to go to $50, and I'll have a huge bunch of money in a matter of no time. You buy stocks because the fundamentals are improving, or coins, but not just because they're cheap. It's very, very important to understand the background, the unique use case behind every single business or coin. Now, another very interesting one as well. You miss 100% of the shots if you don't take a shot. So this is from Wayne Gretzky. So you got to sometimes take a little risk. Be a little greedy, not too greedy, and take that shot. But again, don't do it haphazard. Don't buy 10 altcoins at $1 each and hope they're all going to explode. Yeah, granted, they might. You might get lucky, but odds are stacked against you. Stick with the winners. Now, the other thing that's very important is losing. Learn to lose and let it go. Don't get emotionally attached. Be a good loser and be humble. So this is a very interesting, another sports analogy. Seems to be a lot of those today. Winners know why they win. Losers don't know why they lose. They blame others. They find fault in others. They don't blame themselves. So again, when you're investing, it's a blood sport. It's you against the machine, as I say. You against professionals. Remember that. If you lose, figure out why, reassess, and then try again. Take that shot. And then humility. I thought about two of the most important things that I could find is, I came up with these two quotes today, putting this together. Great investors find their humility. Again, be humble. Lose well. Learn to win and enjoy winning when you can. And the second one for you all today is have fun. When you invest for fun, it's much easier and it shows in the results. When you don't care and you just do it for sport, it's incredible. And the probability of success is so much higher. I just can't stress that enough. If you find investing stressful, if you don't like it, but you feel compelled to do it, you're not going to be successful. So again, find something you enjoy doing and then do that, whatever the type of investment is, okay? So real quick in terms of conclusions, remove emotion. Number one, be a machine because you're up against a machine. and adapt and be a good loser. If you lose, find out why you lose and make yourself better to jump back into the game. And use a system that fits your type and make sure you enjoy it. Adapt, improvise, and always keep learning. Always keep learning. The game is changing. The markets are moving faster. 80 to 90% of trades are completely automated nowadays. Again, it's you against the machine. Everything's a zero-sum game. So for every winner, there's a loser. Very, very important. And the more you disengage emotions and the more you have a system in place, the more successful you're going to be. I promise you. So again, make sure you enjoy what you're doing and be disciplined. So hopefully you like this. Stay tuned for the next 4 parts. I'm going to push out 1 a week and it'll cover everything. So keep the suggestions coming. Thank you. I work for you all. Be safe.